The screen flashes green. A stock price ticks upward, hitting exactly $100. It catches your eye. It looks like an opportunity, a clean entry point, perhaps even a bargain. But stop. Before your finger hovers over the buy button, you have to ask yourself if that number reflects reality or just market noise. A price tag is only half the story. To see the true heartbeat of a company, you need a different lens. You need the bridge between what the market demands and what the business actually delivers. This is where the PE ratio enters the frame. It is the fundamental metric that strips away the hype, connecting the share price to the company's ability to generate cold, hard profit. Most investors look at the cost and stop. The smart ones look at the ratio. It is not just about the price you pay today. It is about the value you are actually buying. If you want to stop guessing and start analyzing, you have to master this bridge. It is the first step in moving from a gambler to an investor. Let us strip away the mystery and look at the math. The formula is remarkably simple, yet it reveals everything. Take the current share price and divide it by the earnings per share. That is your PE ratio. Imagine a company trading at $100. If that business generates $5 of profit for every share you hold, the math is straightforward. 100 divided by 5 equals 20. That number 20 is the key. It tells you exactly what the market demands for every single dollar of profit the company produces. You are paying $20 for $1 of annual return. It is a measurement of expectations. If you are looking at two companies, one with a ratio of 10 and another with a ratio of 50, you are essentially asking yourself how much you are willing to pay for that profit stream. It is not just a calculation. It is a conversion of price into a measurable cost of performance. By breaking it down this way, you stop looking at the price tag as a random number. You start viewing it as a quantifiable commitment to the earnings power of the business. Now, the interpretation takes a turn. You see a high P/E ratio and the market screams growth. Investors are betting on the future, paying a premium today for the massive earnings they expect tomorrow. This is why tech giants often trade at multiples that seem astronomical on paper. But then, there is the other side of the screen. You find a stock with a low P/E ratio, trading at a fraction of its peers. Your instinct tells you that you have found a bargain, a hidden gem waiting to be discovered. Stop. That intuition is the trap. A low ratio is rarely a simple discount. It is often a warning siren masked as an opportunity. Ask yourself why the market is refusing to pay a premium. Is the company drowning in unmanageable debt? Is it operating in a dying industry where the core business model is slowly evaporating? A low price does not mean the asset is cheap. It often means the risk has become too heavy to ignore. You are not looking at a bargain. You are looking at a company fighting for its survival. Never mistake a sinking ship for a sale at a department store. Before you commit your capital, look past the low number and identify the rot hiding underneath. Context is the only thing that saves you from a fatal miscalculation. Consider a high-growth tech startup trading at a P/E of 30. Investors see innovation, scalability, and a massive runway for future expansion. That number is their vote of confidence in the company's trajectory. Now, take that exact same ratio of 30 and apply it to a traditional, century-old regional bank. The market does not see growth. It sees a bloated, stagnant institution that cannot justify its price. In the bank's case, a P/E of 30 is not a sign of potential. It is a glaring indicator of a bubble waiting to burst. The number did not change, but the reality shifted entirely. You cannot treat these businesses as if they exist in a vacuum. You must compare a company against its own historical performance, its direct competitors, and the broader trends of its specific sector. If you ignore the context, you are staring at a mirror and calling it a window. A P/E ratio is merely a data point, and data without a frame of reference is noise. To see the truth, you must map the number against the industry landscape and the company's own history. Only then does the math stop lying to you. Let us be clear about what you are holding. The P/E ratio is not a crystal ball. It will not predict the future. It will not tell you if a stock will rise tomorrow, and it will not guarantee a profit. It is a thermometer. It measures the current temperature of market enthusiasm. When you look at that number, You are seeing the collective pulse of every other investor in the room. Some are greedy, some are fearful, and many are simply following the crowd. Before you click that buy button, you must step back. Check the ratio, map it against the sector, and look beyond the surface. Financial mastery is not about finding the one perfect metric that unlocks the market. It is about building a toolkit that allows you to see the reality behind the price tag. You have the tool. Now you must develop the discipline to use it. If you want to keep sharpening your edge, subscribe to this channel. Drop a comment below and tell me which metric we should break down next. The market is waiting, but do not move until you have done the work.